Hi everybody. In our last video we discussed trading securities. In this video we'll discuss the accounting for available for sale securities. Both trading securities and available for sale securities need to be reported on the balance sheet at fair value. So why should we use an accounting approach for available for sale securities that is different from the approach used to account for trading securities? Well, because available for sale securities are likely to be held for multiple accounting periods, one could argue that there is sufficient time for unrealized holding gains in some periods to balance out with unrealized holding losses in other periods. So including unrealized holding gains and losses in net income each period would confuse investors by making income appear more volatile than it really is over the long run. But how can we show available for sale investments at fair value in the balance sheet without recording the unrealized gains and losses associated with changes in fair value in the income statement? The solution is to show those unrealized gains and losses in other comprehensive income as they occur, and then only include realized gains and losses in net income in the period in which an investment is actually sold. As we work through these examples, you will find that accounting for available for sale securities is very similar to the accounting for trading securities. The primary difference is that with trading securities, the unrealized gains or losses are recorded in the income statement to arrive at net income. With available for sale securities, the unrealized gains or losses are reported in other comprehensive income rather than in the income statement. Let's assume that United properly classifies its investment in the masterware bonds as available for sale. As with the examples we worked for trading securities in our previous video, United needs to adjust the bonds to their fair value at the end of each reporting period. United will use a fair value adjustment account to make this adjustment. As of December 31st, 2021, the masterware bonds have increased in value to $714,943. The bonds are recorded at their amortized cost of $671,297. So the fair value adjustment account needs to have a balance of $43,646 debit. Until United will recognize whatever unrealized holding gain or loss is necessary to move the fair value adjustment from its current balance, which is zero. So the journal entry United will make at December 31st, 2021 is debit fair value adjustment, $43,646, credit gain on investments, reported in other comprehensive income, $43,646. Notice that the amount of unrealized holding gain is the same for those available for sale securities as it was for the trading securities in the previous video. What differs is that unrealized holding gains is included in other comprehensive income for available for sale securities instead of in net income as it was for the trading securities. At the end of the reporting period, the unrealized holding gain is closed to shareholders' equity for both approaches. What differs is that net income gets closed to retained earnings, but other comprehensive income gets closed to accumulated other comprehensive income. As with trading securities, the fair value adjustment will be adjusted up and down each period, either for individual securities or for a portfolio of securities. but the corresponding unrealized holding gain or loss will be reported in other comprehensive income for available for sale securities. Net income normally is not affected by available for sale investments until the period in which an available for sale investment is sold. When an available for sale investment is sold, as with trading securities, we first need to update the fair value adjustment account and recognize any unrealized holding gains or losses that have occurred during the current reporting period just prior to the sale. Remember that on December 31st, 2021, the amortized cost of the Masterware bonds was $671,297. Hasn't changed. And the fair value at that time was $714,943. We recorded a fair value adjustment of $43,646 on December 31st for this unrealized holding gain, and that is why we now have a beginning balance in the account of $43,646 as shown in this T account. Now, on January 5th, 2022, the fair value has increased further to $725,000. So we can calculate that the ending balance in the fair value adjustment account needs to be a debit of $53,703. Therefore, we need to update the fair value adjustment account for the additional $10,057 required to increase the balance to its correct ending balance. The journal entry to record the increase in fair value adjustment account and to record an additional unrealized gain of $10,057 that occurred during the first week of 2022 is shown. Debit fair value adjustment, $10,057. Credit gain on investments. Other comprehensive income, $10,057. After that journal entry is made, the investment is carried in the balance sheet at its fair value as of the date it's being sold, and all unrealized gains and losses associated with the investment have been included in other comprehensive income. United has been recording changes in fair value over the life of the investment and reflecting those changes as unrealized gains and losses in other comprehensive income. If United now sells that investment, the effect of those fair value changes must be reversed. United reverses previous unrealized holding gains included in other comprehensive income by debiting a reclassification adjustment account in other comprehensive income for the same amount. And the balance of the fair value adjustment account is eliminated. Debit reclassification adjustment, which is an account in other comprehensive income for $53,703, and credit fair value adjustment for $53,703. After this journal entry is recorded, the fair value adjustment account has a zero balance. Also, after the reclassification adjustment is closed to accumulated other comprehensive income, all of the unrealized gains that are associated with the investment will have been removed from the accumulated other comprehensive income holding tank in shareholders' equity. It's as if no accounting for unrealized gains or losses had ever taken place. That's important because in the next journal entry, United will recognize the entire realized gain or loss in the income statement. If United didn't use the reclassification entry to back out unrealized gains and losses from accumulated other comprehensive income, it would end up having double counted them in comprehensive income and in shareholders' equity after it records the sale of in the next journal entry. Now that all of the unrealized holding gains and losses and the fair value adjustment account have been cleared away, the final step is to record the realized gain or loss in net income. The entry is identical to the entry United made to record the sale of the investment under the held-to-maturity approach. As with the held-to-maturity investments, no gain or loss in the income statement over the life of the investment is recorded. Instead, the entire gain or loss is recognized in net income at the time of sale. The difference between accounting for held-to-maturity and available for sale investments is that unrealized gains or losses are not recorded at all for held-to-maturity securities, but unrealized gains and losses are temporarily recognized in other comprehensive income for available for sale investments. That requires an investor to remove the amounts that are included in other comprehensive income and to recognize them in net income at the time of sale. In United's case, the second and third entries essentially reclassify a $53,703 gain from other comprehensive income to net income and thus to retained earnings. That's why the process is called reclassification. Available for sale securities appear in the financial statements as follows: income statement and statement of comprehensive income. Unrealized gains and losses are shown in other comprehensive income in the periods in which changes in fair value occur. Those amounts are reclassified out of other comprehensive income and recognized in net income in the periods in which the securities are sold. Balance sheet. Investments in available for sale securities are reported at fair value. Unrealized holding gains and losses become a part of accumulated other comprehensive income in the shareholders' equity and are reclassified out of accumulated other comprehensive income in the periods in which securities are sold. Cash flow statement. Cash flows from buying and selling available for sale securities typically are classified as investing activities. Illustration 12.9 in your textbook shows a comparison of the held-to-maturity, trading securities, and available for sale approaches. This is a very useful illustration, and the page should be flagged for future reference. This side-by-side comparison highlights several aspects of these accounting approaches. To record the purchase of an investment and the receipt of interest revenue, we use identical entries in all three approaches. To record changes in fair value, the entries we use for trading securities and available for sale securities have the same effect on the investment via the fair value adjustment account, and the same eventual effect on shareholders' equity. What differs is whether the unrealized holding gain or loss is recognized in net income and then in retained earnings, as it is for trading securities, or recognized in other comprehensive income and then in accumulated other comprehensive income, as it is for available for sale investments. No fair value adjustment is reported for held-to-maturity securities. Let's work a concept check problem. S&L Financial buys and sells securities which it classifies as available for sale. On December 31, 2021, A bond has an amortized cost of $800,000. The bond's fair value adjustment account has a debit balance of $20,000, but the bond's fair value is now $825,000. Please pause your video and write the journal entry necessary to adjust the fair value adjustment account at December 31st, 2021, and then select the correct multiple choice answer. A. Debit to fair value adjustment of $5,000. B. Credit to fair value adjustment for $5,000. C. Debit to unrealized holding gain on available for sale investments, OCI, for $5,000. Credit to fair value adjustment for $25,000. Please start the video again when you are finished to check your work. The correct answer is A. The fair value adjustment needs a debit balance of $25,000 to adjust amortized costs of $800,000 to the fair value of $825,000. Given a pre-existing balance of $20,000, an additional debit of $5,000 is required. The journal entry is debit fair value adjustment, $5,000. Credit gain on investments reported in other comprehensive income, $5,000. Well, that's all for this video. In the next video, we'll begin our discussion of accounting for equity investments.